All right.
Awesome. Welcome, everybody. Jody Humphrey here, coming to you from Atlanta, Georgia. Excited to have you here, along with my partner today, Miss Kimberly Odie. And she's always here doing such a fantastic job with me, along with Zach and the great Tim O'Rourke. We got a great program lined up for you today. It's a conversation. We had hopefully you guys are having the same success that the rest of us are. Activity levels through the roof. People are excited. People want opportunity more than ever before. So let's go make it happen. Now, don't forget, tomorrow night is our business opportunity presentation, a world class style. If you haven't been on Thursday nights, you need to be. We're going to make sure and give you the brochure. We have a brand new flyer that goes to all the different time zones and a couple of different opportunities you can send people. We got one flyer you can send that's got the logos of the company, Team Legacy logo and HCI logo, and there's another one that's just clean that you can send to get one tomorrow night. But just remember, we are in the invitation business. We are in the business of distribution. There's two things we're trying to build. I trained on this last night. I want to go back to this. It's the fundamentals. Okay, everything comes down to two things in our business. There's two things we focus on. One's dying too soon. The other one's living too long. That's it. Bottom line. That's what we do. And then on the other side, what we do is that your job is to build a large outlet, a network of outlets, and then a large group of multi-product using clients. It's straight out of the manual. And I'm talking the original Magic of Compound Recruiting manual. So I'll say that again. You're here as what we do on this call is we guard against dying too soon and living too long. And then the other is that you're here to build a large network of outlets and that you're also here to build a large base of multi-product using clients. That's what we're about. That's our fundamentals. That's what we're all about here. We're the best at it in the world, excited for it. Obviously, there's a lot of crazy things going on in the market and in the world. So we're excited to hear from the great Tim O'Rourke to start us off today.
Hey, thanks, Jody. Hey, everybody.
You bet.
Um,
Hey, hey.
got some interesting things going on today, but one of the big things I want to talk about later in a minute. Well, actually, let me cover kind of the market because I think I want you all to understand something about markets and what's going on today. Is we're seeing really a sideways move in the stock markets right now, and we're seeing rotation. Rotation meaning investors are, when I say investors, I mean the computer programs really move in and out of different sectors according to their actual programming. And so we're seeing it move in and out of tech stocks, in and out of software specific stocks, in and out of different sectors in these stocks. And what it's causing is a little bit of the up and down gyration in the market, and we're seeing that a lot. Um, we're seeing it because AI is causing a lot of disruption right now. It's causing it in real estate. If you saw some of my Tim Talks comments the other day, we're talking about it's affecting crypto, oil, real estate. I mean, look at real estate right now. It's still been Real estate has really been disrupted quite a bit. Silver and gold. I mean, we saw silver drop 30% in one day, and it's still kind of gyrating all over the place. I mean, it's kind of one of those things that it's really difficult to pick out where that market is going. Anybody who thinks they can pick out where precious metals are going, tell them they're crazy. But anyway, the point of all this is the markets are going sideways from now right now until they get a direction. And that's why we offer these products that we do because we've got a floor, we got protection. And that's one of the things, we talk about this all the time. Jody talks about it, Kimberly and Zach talk about it, I talk about it, Mauricio talks about it. We talk about safety, we talk about protection. That's what we sell. And AI is disrupting everything. We're already seeing the effect of AI in capital spending. And this is one of the things that the markets are trying to they're trying to understand really where all this spending is going and what that means. So when you think Meta is building a new data center, what's the effect of that? How's that going to play out with the labor market? What's all that money going to generate as far as revenue to Meta? Well, also, my question is, how's that going to affect the job market? You know, everybody's saying we don't know about AI. Artificial intelligence is going to have this massive impact on labor markets. Well, there's going to be some sectors in the economy that are going to benefit from AI. There's going to be others that are going to be destroyed. And what I mean by destroyed is jobs are going to be taken away. Job openings have been declining since I think it's been about no, let's see, actually August, September of last year, we saw about 7,500 new jobs created, and all of a sudden now they've been declining steadily. You know, some are saying that's attributed to artificial intelligence. It's starting to get into the economy. There's a lot of money now spending data centers, so that's propping up the construction market. Okay, that's what they call bricks and mortar, right? But in the long run, there's going to be a lot of labor positions replaced by artificial intelligence. Bingo. Is that our market? Is that white collar jobs? Sure. A lot of that's going to be white collar positions. That's going to be a lot of other positions in various industries. Real estate is going to be a big one. That's going to be the legal community. I mean, you know, when you think about the impact of this, this is going to be widespread throughout our economy. And this means that and by the way, it's not going to affect us, not at all. And here's the reason why. You know, I find it interesting that I see it in the news all the time. The financial services industry has been under attack lately. They think that it's going to affect our industry. Well, it really isn't. We're going to need translators. That's what we do. We are financial translators. We connect. We're the transition people. We connect with the people in the middle. We connect with the people on Main Street. That's our role. We are the ones who explain how the products work. We are the ones who sit down and do a financial needs analysis. We use the tools that Mauricio has. We use the tools that the product providers have. These are important tools in order to help people understand where their holes are in their game plan, right? The holes in what they do in life and how we can protect them. And so what we want to do basically is go out and translate, do a financial needs analysis, show them the products that we have that are a fit and make sure it's the right fit. And that's where I think the markets don't understand the financial advisor out there, that we are the most needed people out there. That's not going to affect what we do. We are probably the most important clogging or component in the whole wheel out here. So as I see AI kind of replace people in the labor market, it's not going to be us, but that gives us a great opportunity. And you know, the Fed's going to try to they're meeting I think 7 or 8 more times this year. You know, one of the big things is, will they reduce interest rates? And that's their way of trying to help the market and help jobs. I don't think they're going to have any effect, really. This new guy coming in, his name is Kevin Warsh. He's concerned over the Fed's balance sheet. Now, what that means is, if you've heard my talk, this was a few weeks ago, about the Great Lie, basically, that what they're doing is they're using a trick basically to undervalue the currency and also inflation to hide the way that they're going to pay for all this overspending in Congress. And so this is through the Fed's balance sheet. So Kevin Warsh is concerned over the balance sheet that the Fed has. So the Fed is basically making up money in thin air and paying off the debt, basically paying off the interest. So they're borrowing money that they're just making up, and they're basically loaning money against themselves and doing this in a, I call it a fraudulent way, but they call it they call it quantitative easing. I call it the greatest lie on the face of the earth. But anyway, they're going to continue doing this. He's going to challenge it, but really he's got no skin in the game. So this is going to continue on. I think as we see this whole thing play out this year, it's going to be interesting to see that, and see where that goes. The other thing that's happening is the Supreme Court's decision on tariffs. That's pending any time now. But I think the administration, Trump and his legal team are going to find a way around that, and somehow they're going to work out a way to keep tariffs in place because that is an income producing kind of asset for the United States. But back to AI, I think that's our greatest asset right now is what we do is going to give us more opportunity because there are going to be a lot of people who are going to be looking for jobs. And I think that's our mantra right now is go out and talk about that. That's something that we should be aware of. So that's my note for the day, Jody and Kimberly. I'll let you all take it over from there.
We appreciate it so much. Guys, listen, I know that this is a product call, especially on Wednesdays, Men Wealth Wednesday. But I just want to talk for a second about how I am so in alignment with what Tim just said, that you need to be so bold. And it isn't just, the recruiting opportunity isn't just cool right now. It's needed. It's desperately needed. Most everyone, if they could have another $5,000 to $10,000 a month, or $2,000 to $10,000 a month coming in, it could change everything about their very existence. We were kidding around last night that most people, if they have another 5,000 a month, that they could change zip codes. And then I kiddingly said it could keep them from having to change zip codes. They can stay where they're at, and so I really believe that. We got a lot of people that are chasing dreams. You look at people that are entrepreneurs that are maybe starting a business, or somebody wants to stay being a realtor, or somebody is an artist, or somebody's a songwriter, and they're chasing their dreams. Well, they got to monetize those dreams along the way. And what an incredible business to be able to go out and do those things, to give your kids a chance to have options on schools, to have options on all these things. And, we've got this great group of kids. I call them kids, are 23, 24-year-olds in Florida that joined Hurston's team. That there's 3 of them that they all paid for their weddings. They all had dream weddings that they wanted to have. And they cost about $50,000 to $75,000. And all of them paid for their weddings just by using this business. And so this business is a dream making machine. Now, the other side of this is I want you to kind of imagine somebody, how right now on, I think it's Instagram, everybody's kind of getting these little cartoons made of themselves. And some of you know what I'm talking about. But I kind of imagine if you're that guy, it's that there's an AI thing that says, imagine yourself what you would look like as a warrior. And you can put it in your picture and it shows you back as Tim comes back as this great, Viking warrior or whatever, right? And so here, imagine that you got 2 shields that you're holding. One of them is the opportunity, but the other one is what we do for families. It is unbelievable. If we got to be so strong and being bold to get families covered. We talked about that in our bot last night. Every time I talk to all the different Matt at Corbridge, he's very good about the nobility of covering families. And everything we do. I want you to think about this. If someone does not have one of our products when they are supposed to have one of our products, it's usually catastrophic. If somebody didn't have life insurance, it can be devastating. If someone hadn't done the right tax planning on the back end, they can undo their whole retirement. If the market corrects and they're not in an indexed account, it can be generationally devastating. If somebody doesn't have a will and a trust, if somebody doesn't have all these things, that's how important all these products are. So that's exciting to be, something I'm very proud of. So thank you, Tim. Appreciate you.
My pleasure.
You bet. Okay, Kimberly, let's kind of lead the discussion. We got just some ideas and conversations today to talk about, as well as and so we like case studies. Now, listen, one of the things that we were in the habit of for a while, I'd like to get back to it, is that if you have case studies or someone that you want to bring something to our attention, meaning that you've got somebody and this is their situation, yeah, we love to use them as case studies on here and talk them through. And so we got one today to kind of talk through, and then we just got some different ideas. So Kimberly, turn it over to you.
Awesome, thank you. Well, first thing I'm going to do, we have an annuity cheat sheet that Jody and I've been working on, and we were just looking. We got we borrowed it from one of our other leaders and edited a little bit for our team. But this is a great, what do I do? Where do I put this money? How do I know which annuity is right? All of that. So let me see if I can make this full screen. You guys see it now? All good? Yeah. Okay. If not, tell me. But ultimately, an annuity cheat sheet, right? So when we're looking at annuities, we're looking at two different things. We're looking at cash accumulation, or we're looking at income. What is the option? What is the objective? What's the client looking for? How long do they have? What is that? What are we solving for? What's the problem? And so if you look at this is telling you cash accumulation versus income strategy. It is not a catch-all, so hear me when I say that, but it is a good rule of thumb. It is a good guide to say, maybe this is what I should look at for this client if they're interested in a fixed indexed annuity. So category one is cash accumulation. Typically, that is for younger clients. If we're not planning for income, maybe it's for older clients, but typically it's for younger clients. It's best for clients who are ages 45 and younger. They're not focused on income payouts yet. They're looking for long-term tax deferred accumulation, and they want to build buckets for future retirement, build future retirement buckets. So key positioning, we're maxing out accumulation today so we can plan for income later. Products in this category that we use and that we use often, F&G Performance Pro, the Athene Performance Elite, the North American Charter Plus. And their core features on these is they offer premium bonuses on the actual money. Because remember, we want this money to grow. We're looking for cash accumulation, which obviously means growth. And they're focused on the account value growth, index strategies for accumulation, the tax deferred growth that comes with an annuity, and then the flexibility for maybe potentially future income election, because a lot of them have that. So who are the ideal clients in this? Just kidding. Young professionals, entrepreneurs, early wealth builders, clients who are already maxing out their Roth, their 401k, their IULs, and they want another bucket. Someone who's inherited some money, someone who's got a big lump sum from somewhere that they don't want to turn into an income stream. So talking points for agents. This is about building a larger pool of money first, not turning income on right away. If they want to turn income on right away, this isn't the product for them, right? But category two are your income strategy annuities. So it's for future retirement income planning. This is best typically for clients who are 45 and older, because typically that income is going to turn on in 10 to 12 years. So you want to be on the higher end. You could probably even say 50 and older, because you want to make sure that during that income planning phase, it's going to work for them. Clients who want that guaranteed future income, pension style retirement planning, where they just get a paycheck every single month for the rest of their life. Longevity protection, they're not going to outlive their income, which is huge. And here you just say we're building a future paycheck. We're not just growing your money. We're not focused on what the value of that lump sum is going to be at the end of the day. We're focused on what your income is going to be, because that's what matters most. Products in this category, Annexus New Heights that we use quite often, Athene Velocity, Athene Pro Bonus, North American Secure Horizon, and you guys know we have a million of them. So there are a lot of other ones here that fit that category as well. The core features on these products are their income-based bonuses. So the bonus is not on the cash accumulation, it is on the income. Their enhanced income rider growth, right? So if you think about the Annexus New Heights through Nationwide, that's a 30% bonus on the income, and it's a 9.5% bonus on the growth. So that on the income growth, right? It's designed for lifetime income later, and it helps offset your sequence of return risk as far as, can I pull 4% from my account value every single year without outliving my income? Here, it doesn't matter. So it's great to use for a portion of someone's guaranteed income strategy at retirement. Who are the ideal clients for this profile? Pre-retirees, rollovers from 401ks to IRAs, old 401ks and IRAs, clients concerned about outliving their money, and conservative investors seeking those guarantees. So talking points for their agents, the strategy isn't about the biggest account value, because it isn't. That's not what we're doing here. It's about the strongest future income. And typically when people are closer to retirement and they're literally looking at what's my income going to be, they want income. They want the guarantees. They want to know what's going to come into them and that they're not going to outlive their income. So simple decision framework, ask their age and what are their goals. If they're under 45, probably accumulation strategy. If they're over 45 to 50, you're probably looking more towards the income strategy. But ask the real question: do you want the money to grow first, or design retirement income now? And that will help guide you as to which one you're actually looking at. And this is just a quick comparison table. Age range, less than 45, accumulation. Main goal is to grow cash value. Bonus type is a premium bonus. Focus is account value. Best for long-term builders. Products are the F&G Performance Pro, the Performance Elite, the Charter Plus. And then income planning is 45 plus, lifetime income rider bonus, income base, retirement planners, and New Heights Select Velocity Pro bonus, Secure Horizon, all that fun stuff. Jody, can you take this for a quick second? I have a FaceTime kid. Just got to check.
Yes, I got everything covered. No worries. Is there any questions on what we just showed you? What we're trying to do is that we want to make this very, very simple. Everything about what we do, we're trying to take it down a level, then take it down another level, make it very clear. You're going to have some things we're going to talk about in a few minutes with Mauricio going over technology. And yes, technology will help us pick things along the way. But this is kind of even pre that. So you can have a little checklist so that you don't have, multiple client or multiple choices in your mind, because usually what happens is a cluttered mind doesn't do anything. And also with a client, that's when someone has multiple options, or if there's any confusion, they do nothing. That's the problem. Most people end up doing nothing. And so we're just trying to make it very simple for you to go through and to know which products fit. Because listen, honestly, if you look about us being in the duplication business, you've got to go make this as duplicatable as possible. The way to do that is to go into those areas where we're going to have 90% of our business, which is you sit down with most everybody that we see, you're going to have that group need probably a substantial amount of term insurance and IUL to fit what that gap is and what they can put away. But then also roll a small IRA that happens to be there, $50,000 to $100,000 on a normal basis. That is our rank and file piece. So they will need a will and a trust, possibly rolling that money over. And then what happens is, as you go to there's only two types of people. There's people who can afford term, and there's people who can get IUL. There's people who need an income, based product, and there's people that are just into the accumulation product, and it's just that simple. Everyone I know in the business that's really successful has a very simplified philosophy as to what they sell. I can go take you through most, even on the life side, they get a company that they feel real comfortable with and they pick and they choose on that. So Kimberly?
Um, so yes, thank you. Thanks for stepping in
worries.
for me for just a quick second. Okay, so quick disclaimer from Tim's request. Obviously, this is a long-term investment for any of your clients. Most of them have a 10 to 12 year surrender period, which means they're not going to lump sum that out. And if it's coming from a qualified plan, they can access it before 59 and a half, just like anything else, right? So we all have to make sure that what we're doing is suitable, that we're giving our full disclosures and things like that. But I just wanted you to know conceptually today,
Can I say
who does
something
it fit
about that,
for?
Kimberly?
Yeah.
This is real important, guys. Um, in this business, the conversations we have behind the scenes are always interesting. Like when we talk about doing a BOP, our conversation is, do we do more talking about the dream, making money, or do we do more about the product? We're always working on that balance, and I'm always wanting to show you the great things that Mauricio is working on. At the same time, I have great concern about it overwhelming you and all these things that we have to balance. I'll tell you something that I don't think is even negotiable is that when somebody comes on board, they need to go through and understand a basic understanding of how money works. And what I mean is that the very basics. And I think we sometimes think we need to skip them because fundamentals are what make great teams. And what I'm getting at is this is that if you do not understand the difference between qualified and non-qualified money, that's a very basic understanding.
And we
And
have field
if you
trainers.
don't, well, I don't care if they learn it from Google, Chat GPT, their field trainer, their mother, and everybody. I'm just saying they have to understand it, how money works. And she's completely right that they should learn it from their field trainer. But I am telling you, a person has a responsibility of their own. Now, listen, when you come here, one of the reasons you go through the client process, the client experience, isn't for us to sell you a policy. It's for you to be able to get your financial house in order. And part of that, which is part of the field training process, because I'm just telling you right now that I would be willing to bet you a nice dinner that half the people that get on calls could not really understand the basics of some of these things. And I'm just telling you, get fundamentally sound. There's fundamentals, and that's what we're doing on here. That's what we're teaching weekly is how to become fundamentally strong and understand it because it is a basic thing. Because not only that, getting back to the compliance part, getting back to the suitability part, getting back to helping the client. If you do not truly understand qualified money versus non-qualified money and those kinds of things, you're going to get off into all kinds of one, it'll look like you don't know what you're doing. Two is you can cause harm that's almost irreparable. So understand that fundamental thing, which actually is a good subject to knock out here in a couple of weeks on this Wednesday call, really getting in there and rolling up our sleeves on it. So, um, that's what we're talking, whether something, what Tim was saying is that if something is an annuity or I don't matter if it's an annuity, whether it's in active money management or land banking, whatever, the rules of it being qualified money apply the most. And meaning if you take out money early, all the things that go with it doesn't matter what the product is. It's what the status of the product is. So make sure you get those fundamentals down. Yeah, and I'll go back right now. If you go into the back office, there's a incredible book called Conquer Your Financial Future. Where you go in and it's a great read on, and everybody needs to be reading it on how money works. So anyway, I'm just excited about that. So I think it's a great point, Kimberly.
Awesome. Thank you. Okay, so let's transition into this financial needs analysis and this sample client. And Jody, you might want to help me with it. I'm going to pull it up and show it, but some of it, I didn't have these conversations. So we want to kind of talk through this together and see where the opportunities are. But in this example, it's through one of the simple F&As. So you guys have seen that on Abacus. Let me see if I can, hold on a second. Let me see if I can make it full screen also. Let me close that one. All right, we're gonna see if this works. But you guys have seen the sample F&A on, or the simple F&A on Abacus, and that's what this was created to do, was to use with that. So this is one of the comprehensive financial analysis forms that it prints for you. I've obviously deleted the client's name, but down here it would say prepared exclusively for whoever your client is. So it looks really good and it looks really professional. But here's a snapshot of this client and where he is right now. This is and his wife. This is the summary. Their cash flow on a monthly basis is about $8,000 a month. Their total assets, $142,500. Total debts, $257. Emergency fund, they've got 7.5 months instead of the necessary 3. They've been 84% covered in insurance, 27% towards retirement readiness, 0% in savings, and zero debt to income. So he is 43 and wants to retire at 65. So they've got 22 years towards retirement. Married, their spouse is 34 and they have 2 children, right? All of this is information that you've taken on their F&A and you've input into the screen, into the system. Now, on their cash flow, net income is $11,000 a month. Actually, their total household income is $16,000 a month. And if you look at it, their net income for the client's $11,000, net income for the spouse is $5,000. The monthly expenses are $8,000. So their positive cash flow that they have should be about $8,000 a month, right? Right now, they aren't putting anything towards savings, or at least that's what we told this simple F&A. Their debt to income ratio is 0%, which is amazing. And what are the opportunities here? They have $8,000 a month based on this screenshot that could be directed to savings, debt payoff, or protection. And if we look down in the green, it says, where should your money go? If we follow the 50-30-20 rule at minimum, right, just to give us some options on what that looks like, your needs are 50%, which are housing, utilities, insurance, food. That's about $8,000 a month. Your wants are 30%, which is entertainment, dining, shopping. That's about $4,800 a month. And they should be applying about $3,200 a month to savings and debt payoff, based on that 50-30-20 rule. So we're going to look through this and see what our opportunities are as we go through this process. And again, this printout's only as good as the information that we put in. So if they're really putting $500 a month towards savings and we didn't input that here, it's not picking that up, right? So understand that. So the next page, debt analysis. They have a $230,000 mortgage. They have $27,000 in car loans. If they wanted to pay off their debt, they could pay off their car loan in 2 years and 10 months by using this, the avalanche method. This is something that you can check. I asked Mauricio to change that for us. I don't really think we should avalanche a car loan. Student loans, personal loans, credit cards, maybe, but car loans, I don't really think that's something we should typically look at. So that's something you can check or not to include it in your debt elimination period on the updated simple F&A. But they look like they're in pretty great shape from a debt perspective. Nothing's really out of line. They don't have a lot of debt other than a house and a car, which is normal and typical. So let's go to the next page, emergency fund. And remember, we're going through our 6 steps. Step 1 is increase cash flow. Here's our cash flow analysis. Step 2 is control debt. Here's our debt analysis. Step 3 is emergency fund. Here's our emergency fund. On this, you've got they've got $60,000 in an emergency fund. $24,000 is recommended. You can also change this with the toggle switch to say, I want 3 months worth of income, 3 to 6 months worth of income, or 3 to 6 months worth of expenses, and change that here as well. It just gives you a little blip about what emergencies cost. A medical emergency could be between $5,000 and $25,000. Job loss could cost $24,000. Major car repair, $1,000 to $5,000. Home repair, $2,000 to $10,000. Just to get them thinking about what they need an emergency fund for. What are some suggestions here? Maximize your savings. High yield savings account typically pays between 4 and 5%. I think they're a little lower right now, so maybe 3 and 4%, but regardless, right? Look for that. With 24,000 in HSA or a high yield savings account, you probably earn an extra $1,000 a year, which gives you an extra, $972 a year just by switching to a high yield savings account. So again, just delivering value, delivering education, showing them where their opportunities are. Now we get to the life insurance, right? Step 4 for us is proper protection. That's life insurance. That's the dime. And we go through this, and it takes their debt, which is $27,000 for the car, their income, and obviously this is just showing one of the spouses, but it does it for both down here. But their income times 10 years, paying off the mortgage and taking care of the kids' education. So he needs a total of almost $1.8 million. She needs almost $1.1 million based on the dime. And the only variable, the only difference here is their income. The coverage gap. So he has an existing term of $1.5 million, and she's got an existing term of $1 million. You can see that down in the bottom right of the red boxes. So his need is an additional $293,000 worth of life insurance, and she needs another $73,000. So what is our opportunity to look at here? Even though a lot of their need is covered, the opportunity for you is to look at those life insurance policies. They might be amazing, and it might not be anything that we need to change, but it might be something where you're like, let me look at that. Let me see if I can save you some money on your term policies. Jamie Hammer's on here. We looked at a client today, and their annual premium's like $12,000 a year, and we're going to be able to get it for $4,500. If we had just said, oh, you've got $2 million and you're covered, we'd never see that savings for them. So this is a great overview, but you still have to take it a step farther to see if there's an opportunity for you and also for them. Also, making sure that those clients have living benefits and, all of those things when you're evaluating their current coverage. So just because they have a current policy doesn't mean it's not something that we want to replace. It is something we want to review. And if it makes sense to replace it, then we'll have that conversation then. So again, footnotes, education, important. What would your family face without coverage? They got to pay $8,000 a month in bills. Bills don't stop if you die. Hate it. Sorry. That's just the truth. $230,000 left on the mortgage, and your child's education for $216,000. Your current coverage, if it's perfect and if it doesn't expire this year, right, would last for an additional 15.6 years of income and finance replacement, not necessarily 15.6 years of actual term coverage left, because it might not be. So good news, term life is very affordable. At minimum, they need an extra $293,000. And the best time to get covered is obviously younger. So tomorrow's going to be more expensive than today. Why life insurance matters. Again, it gives you that education down at the bottom. Income replacement, your family depends on your income for daily expenses, mortgages, lifestyle, debt protection. Outstanding debts don't disappear. Life insurance ensures they're paid off. Education funding. Secure your children's future education regardless of what happens. Final expenses, average funerals are $10,000 to $15,000. Don't put that burden on your family. And then peace of mind. You're going to sleep better knowing that your family is financially protected. So that's step number 4. Now we go into step number 5, and that's the retirement outlook. So they say that they need $12,000 a month to retire, which is $143,000 a year. So we see what Social Security is going to pay. That means that we need to pull almost $98,000 a year from our nest egg at the 4% rule, right? So we've got 22 years to retire, $142,500 currently saved. And you can see the breakdown below, nothing in a 401k, $24,500 in an IRA, $58,000 in brokerage, $60,000 in bank cash. So that is projected to grow to $661,000. If we are using the 4% rule and the 4% rule only, at a 7% annual growth, that we need in order to give us that income of almost $98,000 a year, we need $2.4 million, almost $2.5 million at retirement. our retirement gap based on what we're projected to have based on our current monthly savings is right at 1.8 million. You can see that. So if we were just contributing to a traditional account and contributing that on a monthly basis, we'd have to put at least an additional $2,800 a month into our current assets to allow that to grow at 7% in order to retire at 22 years with $144,000 a year. And the green just gives you a couple of options. If we only could add 500 a month, that's going to give you an extra 312,000 at retirement. If we add $1,000 a month, it's going to give you an extra 624,000 at retirement. So really, it gives you the opportunity. These plans, these FNAs aren't going to tell you what to do. It's going to recognize the opportunities, right? So your retirement income sources, Social Security is estimated at 3,800. Portfolio withdrawal, if we follow the 4% rule, is 2,600 or 2,200. So we see at the bottom that we've got almost a 50% gap. That's a significant gap, and they've got to do something today. It's still going to take your brain to decide, are we putting money in an IUL? Are we replacing a term policy? Are we contributing more to their IRA or to their brokerage account or to their 401k, and to figure out what to do? But this is kind of like a third-party validation that says, hey, we got to fix it. Right? We got some work to do. This is step 5. This is our building wealth in our 6 steps that we go with all of our clients. And then step 6 is estate planning. So they have a will in place. Awesome. If they don't have a trust in place, I strongly, highly suggest that's something that you recommend to them. If you Google, so I was on ChatGPT the other day because I had a personal client I was working with, and I was like, do they really need a trust? Like, they don't have a ton of money. They probably in all had, maybe 1.2, 1.5 million with equity in the house and everything. Do they really need a trust? And from what it said about probate in Georgia, it's going to cost them at minimum $20,000 to probate that will. Then yes, they need a $600 trust. I don't care if you have a will in place. Like, put it in place, make it happen, take care of it, and then you don't have to worry about the trust documents, and it's private and it's not public, and you don't have to pay an attorney, and you don't have to wait years. So control everything you can control before you get into a situation where you wish you had the ability to control it, like Jody said earlier. Don't call me for life insurance when you're sick. Let's talk about it beforehand, right? So key recommendations from this entire conversation is, let's close the insurance gap. We've got at least a $293,000 additional need for life insurance and potentially a replacement on the term. Let's boost their retirement savings. If we can't do $3,000 a month, what can we do and where can we put it? Because anything's better than where they're going to be right now. I'm not really concerned about paying down that car, but it says to pay down the high interest debt and then increase their savings rate, because right now we're showing that they're saving nothing. They've got some money saved, but they're not doing anything systematically. So this is kind of what a sample FNA will show you. And now I want to talk through what are our suggestions? What are our solutions? What are our options for these clients? Does anybody want to help me with this? Anybody want to chat about it? What is the first thing? So we've gone through, increasing cash flow. They've got good income. Could they come work with us? Yes, of course, everybody could come work with us, but let's skip through that one. We've looked at their debt. Do they need to control their debt? I don't really think so, because they just have a car loan. So now we're in step 3. We're now an emergency fund. How's their emergency fund? From what we see, it is fully funded. It is properly funded. So we're good, right? So the first 3 steps we've checked. Now we're in that proper protection section. And let me pull that back up for you guys just so you can see it, so we can kind of talk through this and decide what we would do. We're in that proper protection section. Again, I don't have, and maybe Jody does, I don't know what they're paying for their $1.5 million with the term insurance. I don't know if it expires tomorrow or if they just got it yesterday.
They've
I
had
don't know
it for 1 year. They've had it for a year.
They've had it for, do you know
1
what
year.
they're paying?
No, but they had it for 1 year.
Okay. Do you know if it has living benefits?
We don't think it does, but
Okay. So let's assume that the 1.5 million and the 1 million doesn't have
which we
living
do
benefits.
need to know, by the way. we do need to know. Yes.
Yes, we do need to know, but let's assume, and again, I'm not going to assume if I'm actually meeting with a client and they don't know, or they even if they say yes, yeah, we've got living benefits, great. Can I see the policy? I want to read it because I've read so many policies that have terminal illness rider because everything does, right? If you get sick and you're going to die in a year, yeah, it's got that. But they don't have the critical and the chronic and those other pieces. So I still want to read it. But I'm not going to say, I don't really think you do. I'm just going to say, great, can I read it? Because I want to make sure that they're covered. But let's assume that they don't have living benefits. So that's something that we're going to replace. That is an opportunity for us to offer them life insurance, right? So I want to show you guys a simple, easy way before you have logins and all that kind of stuff. If we go to the back office, and we go to help and resources on our very first screen under tools and resources, you can go to instant term quotes. Let's look at Corebridge. So let's look at this person. They said, and I'll share this. Sorry, I keep going back and forth. So if I make you sick, just close your eyes. But they said that they had 1.5 million, but our need was 1.8 million for him. And he is 43. And are we assuming he's super healthy, Jody? Do you know?
Yes, he is.
Okay, and let's just assume he's in Georgia, 43-year-old, and it's a 1.8
Tennessee.
million, huh?
Tennessee.
Okay,
Just for the record.
$1.8 million death benefit need. If we do it all in term, we might do an IUL, something like that. But if we do it all in term, that $1.8 million super healthy for a, let's just say 20-year or 30-year term is $220. How much commission will you make on a $220 or $220 a month term policy? I know I'm going all through all these little zoomies today, but let's play with it and see if it works. If I'm paying $220 a month, right? And I'm multiplying that by 12. Somebody tell me what that is. Mel, don't write on my screen, whoever's scrolling their things across. Let me do my calculator. 220 times 12. That's a $2,600 premium. Thank you, Electra. $2,640 for this. If I'm at the 45% contract level, what's my income? Electra, want to tell me? And if I'm, thank you, 1188. And will you do 60%? I gotta get better on my if you'll do 60%, 78%, that'd be great for me. Awesome.
It's 1,540.
Thank you.
1,584, I'm sorry.
For the 60%?
Yes.
Okay. 1,584. And what is it at 78%?
2,059.
2,059. So we can see in this example, you're going to make at minimum, if you're brand new, unless you've got a field trainer and you're splitting business or something like that, you're going to make a minimum of $1,200 if that's all we did. But it isn't all we're going to do, right? So if we screen share again, let's see. How do I stop this share? Close. There you go. All right. So if we screen share this again and we look at it for her, she is 34, I think. And her need was 1.3 million, let's just say.
I think she's older than 34. What was it?
She's 34.
Okay.
Yeah. We got to get back to it though. And her need is 1.3 million because that's what it says. And we submit that in this quick term quote. Like, I'm not doing anything magical here. I can give her coverage for 35 years for $80 a month. So now I've got, 220 plus 80 times 12. Now I've got 3,600, which is exactly what we use in that income projection calculator, a month or a year going into just their term policies, probably saving them money but I'm at least giving them more cover. I'm at least giving them more coverage and living benefits. If we decide to do an IUL because that fits into their plan, then we're going to reduce the term coverage. So let's say that the IUL is a $500,000 death benefit. Instead of giving them 1.8 million in term, I'll probably give them 1.3, right? I'm just covering that difference in term. So it's going to take a minute of just playing through those options and playing through those choices to see what you're actually suggesting, but it's there. Other recommendations here. So we know we're making really good money on term policies, assuming they need to be replaced. We know that on their rollover options here, we've got an IRA with 24,500. We've got a brokerage account with 58,000, and then we'll probably leave that bank account. We'll probably leave that bank and cash account liquid, because if we don't and they needed it, then it would be a problem, right? So we won't put that at risk or in the market. But both the IRA and brokerage options, we've got choices. What are those choices? Remember, lump sums and monthly money. This is a lump sum. So you have the ability to put into a fixed index annuity. You have the ability to look at Cal Choice with the brokerage account because it's bigger. I probably wouldn't, because we want the liquidity of it, but it is possible it would fit there. And then we have the ability to, at minimum, pull that money over to WFS, which is like the brokerage account that is already in, to give them active money management, but also so you control that relationship. We don't leave money at Edward Jones or Merrill Lynch or somewhere like that for them to come in and undo everything else that you've done. So opportunities there. Maybe you'll get paid on it, maybe you won't, but it's still an opportunity for you to collect that relationship and bring someone in to help you if that fits their needs. And probably at their age, they need a brokerage account, to be honest. But step number 6 is estate preservation, right? We know that we need a trust. So that is an income opportunity here as well. The other thing, and James, I saw your hands, so I'm going to talk to you in a minute, but the other thing that we haven't seen is how much they can afford to set aside on a monthly basis. And from my conversation with Jody, they can afford to set aside about $3,000 a month. So the question really goes, where does that
I checked on that, by the way. It's more like 2,000.
Okay, so 2,000.
Yeah.
So the question is, where does that money actually go? So let's say on their term insurance, let's say we're not saving them any money, we're just giving them living benefits. So there's no monthly savings from that perspective. But let's say that on the IUL, now what are we going to do with that, right? We have that full $2,000. So usually what I do, if you can afford $2,000, I see if I need to spend some of it on term. Here we don't. We're going to assume it's the same. I see if we need to put some into savings. Here we don't. The savings account's fully funded. So I think we really have $2,000, and there's no debt that we need to worry about, right? So I think we really truly have $2,000 a month that we can look at, that we can put somewhere. Probably at their age, probably based on their health, probably based on their goals. We're going to look at an IUL. It might not be a $24,000 target premium, like dollar for dollar, but even if it's 12, right? Now this one client at minimum is probably a $15,000 client, and you get whatever percentage level you're at from something like that. So I just kind of wanted you guys to see the whole picture, to see what we look at, to see where it comes from, to see what some of the suggestions will be. And also, again, it's not going to tell you what to do. You still have to have someone field train you and teach you and guide you as far as what should I recommend? What does that look like? But it will give you a pretty picture to send back to them and say, hey, these are our shortfalls. Let's talk about them. Let's talk about the solutions. James, I know you had your hand raised and I kept talking. So you ready?
All good. Great thorough explanation. Really love the attention to detail and just going through that summary and translating everything for everyone to understand. One question I do have is, I noticed on the term, when you're quoting the term, you went to the far left and quoted Preferred Plus. Do you typically do that with a client in terms of the quoting of the term? Because in my experience, I like to underpromise and overdeliver and not overpromise and underdeliver. You get what I mean? Especially since they're in their late 30s or mid 30s and early 40s. I mean,
so I'm going to ask them a couple of questions. I'm going to ask them if they're healthy, if they have any medications or any diagnoses, or if they smoke or vape or do the Zen things or whatever, because that all counts, right? If they say no to all of that and I've zoomed with them so I can see kind of their height and weight, like you can't really see, but you can see a lot more than just on a phone call, then I'm going to make a decision on where I think they're going to be, especially, you know, if we're in a situation where we're competing with somebody. I don't tell them if they want to know there's a range here, but ultimately, I think the more you do it, the more you kind of get used to or get good at deciding. But I also say if something comes back different and it comes back and it's more expensive because of a rating or something like that, we can talk about it. And if that happened, then obviously we just tweak the death benefit. If they can't afford it or it's shocking or whatever, because that's, you can't prevent that, right? So if that happens on occasion, then you're just gonna say, all right, well, 1.5 isn't, 1.8 million, whatever we're quoting, maybe that's too expensive. So maybe here are your choices. Let's do a 15-year, or let's do 1.5, and we'll just make those tweaks at that time. And they're usually totally fine with that. But to answer your question, I'm going to quote them based on what I think that they're going to be rated based on just what I know about them.
Couple points real quick. This particular guy, I happen to know him pretty well, and he's actually in better shape now than he was when he bought those policies. So it may be the reverse. You know, it's actually maybe a positive situation. But two other things. One is that I want to make a little plug for Corbridge, and that is that if you try to take this guy out to 65, he really needs 22 years worth of coverage. Well, you can get literally 22 years worth of coverage with Corbridge. They do. That they do it in those year by year, which is a very cool feature. And then also one other point that I don't, she said that I want to make sure that I draw attention to is that when you have that money in a brokerage, if you can get it in a brokerage with us, that's a big deal. And don't look at it, oh, I'm not licensed or whatever to get a 65, then that's a whole nother conversation. That's not got anything to do with why you do that. Is to control it, like she said. If that money's controlled under our atmosphere and within our, stratosphere, if you will, then we're going to be able to help them as we go forward. Also, Kimberly, what's your thoughts on when an annuity becomes a growth annuity becomes an option for someone in this situation?
You want my honest opinion?
Yeah.
I don't think they have enough money at this moment to sit it in an annuity. An annuity is going to be slow and steady growth, and I think that they're young enough and they have time, and they need the possibility of the market. They need that growth. They don't need that security, because right now they don't have enough to retire, and even if they lost it all this year, it's not even going to replace 1 year's worth of income. So in my opinion, they don't need an annuity at this moment. Where I do think an annuity would fit for a younger client, like even an accumulation annuity, if they're totally risk averse, because there are people that way. An accumulation annuity is a perfect fit. If they have a CD and they want to, have a little more opportunity, potentially a fixed index annuity is something like that. If they have an inheritance, if they have a lump sum that they want to set for later and they want to protect that bottom line income, or not income, but asset, I think it's a great option. But I think in their situation, they got to grow that money, period. My opinion.
Really. Sandra?
Hi, Jody. Hi, Kimberly. What if the person is 60 years old and an IUL might not be an option?
Then we wouldn't do an IUL, right? If an IUL is not an option for them, what do? Then you look at what your choices are. It's probably not life insurance, right? And if it is life insurance for a 60-year-old, I love the Corbridge Value Plus Protector with that accelerated access solution rider, which is the AAS rider. And it basically mimics long-term care. So it's going to guarantee a death benefit, and it's going to give them a provision for long-term care like deposits. So I know they're getting that money. If they have a $500,000 death benefit, if they die, they're getting it. If they have living benefit need, they're getting it. If they have a long-term care need, they're getting it. And it also has a return of premium option at 90 and 95. So if I were looking for a life insurance piece for a permanent policy we're not looking at accumulation for them at that point, because maybe maybe health, maybe affordability, whatever doesn't fit. What do I do? Then we look at where best does that $3,000 a month go. And if we don't, got to see the whole picture to see, but savings, make sure that's full first. Depending on their income, maybe a Roth IRA, depending on what they have at their employer. If they have a Roth option on their 401k, maybe that's what we do. Maybe, and if not, then we just do a traditional brokerage account to grow that money, to grow those assets. So they have enough, but it depends on the whole picture, but that would be my kind of blanket answer to that.
And that particular product, because I ran into somebody that was 66 years old. What kind of products? Because I mean, it's happening, and I guess because I'm a little bit older than everybody, I'm running into people that are 62, 66, 75, people that are still very active, they still working, they still need income. They're young, they're married to very young women, or like I had one that he was 66 and his wife was 39. So, and he had a 10-year-old. So how do we protect a person like that? Because I was looking for products and stuff like that, and I couldn't find anything for him.
There might not be an option. I think that's what sometimes we have to remember, is that we can make magic happen with what we have, but we can't do anything more than what we can do. So if he's not insurable, or there's not a final expense product or something like that will cover him from a life insurance perspective, we can do the best with what they have and kind of position it with the best that we think. But then offer them the opportunity. They need to make more money, have them build a legacy here. That's something that will continue to pay forever, right? But yeah, great questions. Jody?
Yeah, and last thing on that, did you say, Sandra, he's uninsurable? Is that what you said? Goods uninsurable?
No, he was 66. I think he's
Then
insurable.
you get term.
No, we looked for term, and it was difficult to find term. Like a cheap
Oh.
term, he wasn't available.
There's
I
not
think
cheap. There's
It's
not
not
cheap.
cheap.
If he's 65, it reminds me of the James. You'll remember this. He had this lady early on. She called me up. She goes, I want to have, $5 million coverage. I want to have $1 million when I retire, and I'd like to save $200 a month. I'd say, well, I like that too. Yeah, we would all like those things, right? But the other thing I want to mention real quick, Kimberly, and I know we're a little bit in overtime, but I got to say this on this case. There was some cash, $50,000-$60,000 that the guy actually has cash. Our recommendation for that was to keep it there inside of for an emergency fund, correct?
Yes, high yield savings.
Excellent. Okay.
Just to say.
Caesar, real quick.
Real quick, thank you, Kimberly. You're such a great teacher. I love the way you explain things. And just quick question: you mentioned not to accelerate the car, and I why is that? Is normally is the highest spend on the debt side?
Well, first of all, if it's a car, I'm much more worried about them planning for their retirement than I am them paying off that car. And usually they can't afford to do both, right? Second thing is most people will always have a car payment. So even if you pay this off quickly now, in 3 or 4 or 5 years, they're going to get another car payment. So it doesn't really affect what you have to work with. And a car is an installment loan. On a car, you pay all your interest up front, just like on a mortgage. It's amortized, with interest up front. So if you overpay that car, it's just reducing the amount of payments that you have to have. And unless you do that significantly, it's not really saving a lot of interest anyway. So those are all of my reasons.
Beautiful. Thank
All right,
you.
guys, let's get ready to finish that up. And as we wrap that up, Kimberly, thanks. I know you got to hop off, but real quick, just so you guys have this.
I'm going to
is
make you host, so I'll hop off just so you know, and so you
You're
can end
fine.
it.
Thank you. All right, but this is the brochure for tomorrow night. We're going to drop this into the WhatsApp, but this is an adjusted one for tomorrow night. It's got the Eastern Standard Time, Central Time, Mountain Time, and Pacific Time on it, so that there's no confusion, or at least to minimize confusion. So that is for tomorrow night. There's also one with the logos across the top. So this particular one has the HGI logo, an Integrity logo, along with Team Legacy. This one is the same thing, but with nothing on it as far as information. So use the two of those. There's even one that's got a picture of me on it, but I don't foresee you guys really wanting to use that. I would rather us use these two. So I'll have these dropped into your WhatsApp. I'll try to make sure you get them from your leaders, but that's tomorrow night. And listen, guys, every one of you, you know that you could get on the phone, invite 5 people to hop on a Zoom tomorrow night. You know you can do that. Do it. You can change your life. We're having a great success on this. I'm telling you to flex that muscle one more time. Do it again this week. What a great job Kimberly did. Great case study. Thank you for having that sent in. And I look forward to seeing you guys next week. Take care, guys.
Thank you.
Thank you.